Hi everyone, I'm Ricardo Gonçalves. Welcome to the special SBS On The Money live stream interest rates decision. We are bringing that RBA decision live as it comes with some immediate reaction and analysis about what it means for the economy, your investments, your mortgage and your savings. So for that, I'm joined by some special guests live. We've got Jessica Amir, she's a market analyst at Bell Direct, Shane Oliver, the chief economist at AMP Capital, and Sally Tindall, research director at RateCity. Thank you very much, all of you, for joining me. Jessica, let's start with you. How exactly are the currency and equity markets looking like as we head to this decision?
Well, Ricardo, the Aussie share market was off to the races from the get-go. Just in the first hour of trade this morning, we're up 1.3%, really following the rally that we had on Wall Street overnight. Plus, the oil price also shot up about 3% as well, both on better than expected economic news from the US, China, and Japan as well. And in anticipation of the rate cut today, 2.1%, momentum built, and the market got as high as being 2% up just around 1 p.m. So that put the market on pace for its best gain in about 22 days. So quite an exceptional day. As for the Aussie dollar, well, we nudged higher by about 0.1% higher earlier to 70.6 US cents, really after the Aussie dollar was sold down in anticipation of a rate cut. So plenty of action on the markets, not just on the track.
Sally, if I can ask you, even if the RBA doesn't cut today, mortgage rates are super low. Just how low are they?
1.79%, if you can believe that. It was a new record set last night. And if the RBA cuts rates today as expected, we can expect that to keep on falling. At the moment, we've got 11 lenders offering at least one fixed or variable rate under 2%, and even big four banks offering rates as low as 2.19%. Did anyone ever think that we would be this low, at the beginning of this year even? It's crazy.
And Shane, we're just waiting for that decision to come through. Is that rate cut a sure thing?
There's no such thing. It's a sure thing when it comes to finance, but this is pretty close to it. I think the market is priced in about an 85% probability of that rate cut, taking the official cash rate down to 0.1%.
All right, Shane, I'm going to interrupt you. It does look like the Reserve Bank has decided to cut official interest rates. What normally happens now is that the RBA releases a statement, and I'm going to take everyone offline for a couple of minutes so you can take a look at that statement. We'll come back to you in a few seconds. I will take you through that statement, though. The RBA saying that it's decided on a package of further measures to support job creation and the recovery of the Australian economy from the pandemic. With Australia facing a period of high unemployment, the Reserve Bank is committed to doing what it can to support the creation of jobs. So this package includes a reduction in the cash rate target to 0.1%, a reduction in the target for the yield on the 3-year Australian government bond to around 0.1%, a reduction in the interest rate on new dwellings under the term funding facility to 0.1%, a reduction in the interest rate on exchange settlement balances to 0, and here's the other big one, the purchase of $100 billion of government bonds of maturities of around 5 to 10 years over the next 6 months. Shane Oliver's going to keep looking at that statement. In the meantime, here's something a bit different. The RBA is going to be holding a press conference at 4 o'clock this afternoon. Now, I haven't really seen that in my 20 years as a business journalist. So the RBA is holding a press conference today at 4 o'clock. And the other thing we should also take a closer look at is just the last line, the last paragraph of the RBA statement, which says, given the outlook for both employment and inflation, monetary and fiscal support will be required for some time. For its part, the board will not increase the cash rate until actual inflation is sustainably within the 2 to 3% target range. And for this to occur, wages growth will have to be materially higher than it is. This will require significant gains in employment and a return to a tight labour market. And given the outlook, the board is not expecting to increase the cash rate for at least 3 years. So there's an actual statement. That's something new too. So given the outlook, the Reserve Bank board says it is not expecting to increase the cash rate for at least 3 years. So let's get some immediate reaction now. Let's start with Jessica Amir. She's standing by with some details on how the share market has reacted. How's it look, Jess?
Well, we're holding pretty firm. We're maintaining that 22-day high. Earlier, the market was up in the order of about 2%. We have lost a little bit of that heat. We're now about 1.9% high, but still, it looks like all the sectors are maintaining their firm ground in the black or in the green, however you want to call it. We are still seeing those energy companies lead the market higher. Beach Energy and Oil Search up about 7%, really following the oil price gain of 3% that we saw on overseas markets. In terms of stocks tied to economic growth, they're continuing to beat a very loud drum today and gallop ahead. The likes of Star City Casino is doing quite well. Eagers, which is Australia's biggest car dealership company, and Stockland, they're all making gains in the order of about over 6% or more, really as the global economy is growing quicker than expected. And this all comes, Ricardo, as well. Overnight, US manufacturing activity jumped to its highest level in 17 years. Japan's export data orders, they rose for the first time in 2 years, and China's manufacturing activity hit a decade high. So you've got this fiscal and monetary stimulus all supporting the economic recovery, and that's what today is really all about. So it's a really interesting time. As for holding rates at a record low for 3 years, this is something that's actually quite not new, and it's really in unison with the US Federal Reserve. So expect lower rates for longer, and this really supports share market growth.
Okay, Jess, we'll come back to you at the end of this stream to get some final thoughts of how the market's acting. Shane, I want to spend some time with you right now. You've had only a few moments to take a look at that longer than normal statement. Why did the RBA cut?
Well, basically because the economy is not expected to recover quickly enough to get the unemployment rate down. And the Reserve Bank says quite clearly the recovery is still expected to be bumpy and drawn out, and the outlook depends very much on containing the virus. So there's just a whole pile of uncertainties out there at a time when unemployment is very high, and the Reserve Bank basically wants to do all it can to get the unemployment rate back down.
How does the RBA feel about the Australian and global economies?
Oddly enough, when you read the statement, I've only glanced at it quickly here, they seem to be a little bit more negative about the global outlook, given the latest surge in coronavirus cases in Europe and the US, but a little bit more positive on the Australian outlook. And I think that's consistent with the continued reopening in Australia. Put it all together, though, if you've got those global uncertainties, you can still understand why the Reserve Bank's feeling nervous about things. And they're also, I guess, concerned that at some point the virus might make a comeback in Australia, just as it has in other parts of the world.
What's interesting too is this package of changes, right? And not just that, but this bond buying program, that $100 billion bond buying program, it's put a figure on it. What does it mean? And how does that impact the average person?
Well, it means that the Reserve Bank will be printing money. They're literally printing money. They're using that money to buy up government bonds. And that has the effect of, one, help making it easier to finance the budget deficit. This year, for example, we have a budget deficit of $214 billion, according to the budget. The Reserve Bank's going to be buying up around, at least they're talking about $100 billion worth of bonds here, and possibly even some more in terms of their yield curve control target. So they're going to be buying a big chunk of the bonds that are going to be issued. That makes it easier to finance the budget deficit. For ordinary Australians, it means a lower cost of funding. If the Reserve Bank is out there pumping money into the economy, buying up government bonds, it pushes bond yields down, and therefore fixed mortgage rates are likely to decline further. So a lower cost of borrowing, whether you're a business or a household, to get a mortgage, it'll be somewhat cheaper. Finally, I think all that increase in the supply of money in Australia will push the Aussie dollar below where it otherwise would have been. And that, of course, will make it a bit more expensive if you want to go on an overseas holiday. Not that many people can do that at the moment, or anyone can do it at the moment, but it does make Australian exporters more competitive internationally, and also it supports companies that have to compete with imports. So all of that, I think, is aimed at making for a stronger Australian economy.
Shane, given rates are now pretty much as low as they can go, what next? What can the RBA do, and what is its role?
Well, that's a good question. I reckon they've scraped the bottom of the barrel here now. I don't think the Reserve Bank will take the official cash rate negative. You can't rule that one out. If the Bank of England, the Bank of Canada, and the Reserve Bank of New Zealand are thinking about it, then maybe they might do it here. But I don't think so. I reckon we've hit rock bottom in terms of the official cash rate. Therefore, all the pressure is on what you call quantitative easing. Ongoing programs of buying up government bonds, pumping more cash into the economy, helping keep the Aussie dollar lower and helping keep longer-term borrowing costs down. So it really is a bit like what the Fed's seen over the last few years now, that they can't cut interest rates any further, or the ECB, they've got to resort to printing money.
Shane, I've got one more question for you, and then I'm going to ask Sally Tindall the same question. Are the banks likely to pass on this rate cut to borrowers and to consumers?
To be honest with you, I reckon they're going to pass at least a big chunk of it on for a couple of reasons. One is there's going to be massive public pressure on them. Number two, they are getting a lot of support from the government, from the Reserve Bank. The Reserve Bank has said, we're going to provide you, the banks that is, with cheap funding for up to 3 years at just 0.1%. So their cost of funding is going down. So it makes sense they should pass that on to their customers. That said, they may not pass the full amount on, but I reckon at least they'll pass 0.1% on. And I reckon we're also going to see more declines in fixed rate mortgages. And that's something we saw back in March as well. They didn't pass the full amount on, but if you wanted to get a fixed rate loan for 3 years, 5 years, it suddenly got a whole lot cheaper. And that's ultimately what I think will happen. If you want to say, well, 0.1% isn't that much, just bear in mind that a 0.1% reduction in interest rate for someone on a $450,000 mortgage is about $400 a year. So I'm sure they'll take that $400 quite happily.
Okay, Shane Oliver, I really appreciate your analysis. Thank you very much, Shane.
My pleasure. Thank you.
Let's go now to Sally Tindall and see what this rate decision means for your mortgage and for your savings account. So, Sally, the same question to you. Do you think the banks will pass this on in full?
Look, I think some banks will and some banks won't. And I think that we haven't had an announcement from any of the big four yet. They may engage in a game of chicken to see who goes first. It means that they're thinking about it. They're thinking about what to do. There will be public backlash if they don't pass on this rate cut. One of the key reasons why is that they didn't do it last time, with the exception of ANZ. CBA, Westpac, NAB, they passed on nothing to their existing customers back on March 19. But, we may see some banks take the plunge. We have already had news that Athena, a low-cost lender, they are passing on the full 15 basis points to both their new and their existing customers. That's great news for their customers. We've seen Mortgage House, they're doing the same. So there's two low-cost lenders out there paving the way. And look, there are hundreds of thousands of mortgage holders that absolutely need this rate cut. Their savings for a $400,000 home loan is about $33 a month. It does seem like small change to some people, but if you are trying to make your budget bottom line add up at the end of the month, that $33 could be a lifesaver for many people, particularly if you're on a mortgage deferral, particularly for people that are in mortgage prison and can't refinance.
What is a good rate for a mortgage right now?
Well, right now it's it was 1.79 when we started this conversation. I've just had news. It is now 1.77 from a different lender. They've come through, reduced and trumped that rate. So we now have a record low rate of 1.77. But really, if you live in the home that you own, if you've been paying down your debt and you still have a steady job, there is really no real reason why you should be paying in the threes. You should be having your set sight in the low twos at this point in time. And there are, like I said, 11 lenders out there offering rates that start with a 1. And we really do expect that list to increase now that the RBA has cut rates.
And Sally, on the flip side, this isn't just good news, because for savers, it's bad news. How tough is it for them, and what can they do?
Oh, look, the outlook for savers has gone from gloomy to dire. Then not only are they going to see their savings rates fall away yet again, but they are not going to see a rate rise for the next 3 years, if not more. I mean, at this point in time, the big four banks are offering 0.05% on their standard savings accounts on an ongoing basis. If they cut those rates any further, we will be looking at 0% savings rates, which means that banks are only a safe place to stash your cash. Now, there are some lenders out there that are offering higher rates. It always does pay to shop around. So if you still want to keep your money on a bank, because the government guarantees it up to $250,000, it is worth shopping around. There are still savings rates out there at 1.5%. That's likely to be cut slightly given today's rate cut, but they still will be a lot more than what the big four banks are offering. So one thing out of this whole outlook for savers is if you are with a big four bank or with a bank that's offering you less than 0.05% for your savings, do yourself a favour, go and have a look at what the competition is like. Take your savings, walk in, because that's the way you're going to go and earn interest in the bank.
Okay, Sally Tindall, really appreciate your analysis and advice. Thank you very much. Thanks, Sally.
Thanks, Ricardo.
And that leaves me with Jessica Amir. She's got the final wrap of how the markets are doing. So the markets have had about 10, 15 minutes to react. How's it looking?
It's been a pretty good 10 or 15 minute reaction, Ricardo. In fact, the market is now officially at its best gain in about 22 days. We're up about 2.2%. That's the best gains that we've seen since the 5th of October. But the market will need to gain more than that to beat that gain back in early October. As for the Aussie dollar, well, that's slightly reversed its uptrend and it's now in the red, slightly less than it was before the RBA's decision. And this is, of course, what the RBA wants. The RBA does want a weaker Australian dollar because, of course, that makes Aussie goods cheaper overseas, and the government and indeed the Federal Reserve wants Aussie goods to be snapped up so that we increase our national GDP. So all in all, it's pretty good, pretty good.
All right, so a low interest rate environment, we're pretty much as low as we can be. What does it mean for shares?
Well, it's actually quite supportive, Ricardo. So typically what we see in low interest rate environments is we see that the market has rallied. In fact, if you... Sorry, Ricardo. And if you look at the 17 last interest rate cuts since 1990, of those cuts, 65% of the time the market has rallied. And the reason for this is lower rates support innovation, job growth, and all of this is, of course, at a time when interest rates and cash rates, as Sally and Shane alluded to earlier, are at record lows. And what does this mean? Well, it's simply very hard for retirees and anyone looking to get bang for their buck to make any money. So the only place that you can invest and typically get a good return is the share market. Now, this is why the share market typically rallies and has rallied in all of those in low interest rate environments.
Okay, Jessica Amir there from Bell Direct. Really appreciate your time. Thank you very much for joining us here on SBS On The Money. Jessica Amir there. So there you go, the breaking news. The Reserve Bank has cut the official interest rate to 0.1%. But more importantly, it's actually delivered a package of changes, which also includes a $100 billion government bond buying program. Its aim is to make sure interest rates stay low for longer across the economy. And the other really big key thing that it said today is that it will not lift interest rates for 3 years. It's put an actual date on it. So we'll have all of that and more on SBS World News at 6:30. Make sure you join me for SBS On The Money during the news then. And of course, there's news anytime, anywhere with the SBS News app, or go to sbs.com.au/news. You can follow me on Twitter and Instagram at Business Ricardo. And don't forget the SBS On The Money podcast. You can find that on the SBS News website and on SBS Radio later tonight. See you soon.
This On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It's not personal advice and it doesn't consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.